So what kind of investor are you? It seems like a simple question, right? But the answer, well, it goes way deeper than just your bank balance. It's really about your personality, your psychology, and honestly, how you feel about risk. Today, we're going to peel back those layers and figure out what's really driving your financial decisions.
All right, let's kick things off with a little thought experiment. Should a billionaire be investing their money the exact same way as a recent grad who's just starting out? I mean, your gut probably screams no, of course not. But the why behind that feeling, well, that's the puzzle we're going to unpack today. You see, in a textbook, the answer is super clean. It's logical. But in the real world, with all of our messy human emotions, that perfect logic kind of falls apart. And this is right where the pure theory of investing crashes into the reality of just being human.
Okay, so first, let's meet the investor who only exists on paper. This perfectly rational person who, without fail, always makes the most logical financial choice.
The whole foundation of this myth is a concept called diminishing marginal utility. Now, I know it sounds a little academic, but think about it like this. If you're starving, that first slice of pizza is absolute heaven, right? But the 10th slice? Not so much. Well, it's the same idea with money. Each extra dollar you get brings you a tiny bit less satisfaction than the one before it.
So here's how that theory should play out in the real world. The idea is, if you have less wealth, you'd be willing to take on bigger risks for a shot at those life-changing returns. But as you get wealthier, the whole game flips. Suddenly, you have a lot more to lose, so you switch from playing offense to playing defense. It all makes perfect sense. On paper.
But of course, reality isn't a clean textbook model. It's messy, it's emotional, and it's fascinatingly irrational. So let's just leave that theory behind for a minute and meet the actual human investor. As one of our sources puts it so well, the world isn't perfectly rational, it's foundedly irrational. And that's because our decisions are driven by our unique personalities and our emotions, especially when our own money is on the line.
And there's a term for this reality. It's called bounded rationality. It's this simple idea that, hey, we're not supercomputers. Our decisions are limited or bounded by who we are, by how much info we can actually process, and by the time we have. We're just doing the best we can within our own personal limits, which means our decisions won't always look perfectly rational to an outsider.
So, if we aren't all these perfect textbook investors, what are we? Well, it turns out most of us can generally be grouped into one of three distinct psychological profiles, and each one has a very different attitude toward risk.
So here they are. First, you've got the risk-averse investor. Just picture a retiree who wants to protect their nest egg. Their goal is simple, to sleep well at night. Then there's the risk-neutral investor. They're a bit like a computer. They only care about the potential return and completely ignore the wild roller coaster ride it might take to get there. And finally, we have the risk-seeking investor. Think of an angel investor or a venture capitalist. For them, the risk is actually part of the thrill. They're chasing those massive game-changing wins.
Now, let's try to visualize what's really going on inside the mind of each of these investors. I mean, how does taking on more risk actually feel to them? What does it do to their sense of satisfaction, or what economists call utility?
For the risk-averse investor, this is super straightforward. As the level of risk in their portfolio goes up, their sense of satisfaction and well-being actually goes down. More risk literally equals more anxiety. They are losing sleep over this stuff.
The risk-neutral investor? Their emotional state is just a flat line. They are completely indifferent to risk. A super safe government bond or a crazy volatile new crypto coin doesn't matter to them. Their satisfaction level doesn't budge. All they see is the potential number at the end.
And this is where it gets really interesting. For the risk-seeking investor, the exact opposite is true. As the risk increases, their satisfaction and excitement actually rise right along with it. They are drawn to the thrill of the gamble, that possibility of a huge payoff. For them, the risk itself is part of the reward. Okay, so we've explored the theory, the messy reality, and these three investor profiles. But here's the most important part. Why does any of this actually matter to you? Look, the big takeaway here is this. Understanding your own risk profile is like a superpower. It helps you make decisions that you can actually live with. It lets you stick with a strategy for the long haul instead of panic selling the second the market gets shaky. It also helps a financial planner match you to the right kinds of investments, making sure you can actually handle the journey without wanting to jump ship. And that brings us to the most important question of all. I want you to think honestly for a second. When the market gets volatile, do you feel a knot of anxiety in your stomach? Or do you feel a surge of opportunity? Which one of these profiles really sounds like you?
And please remember, there is no correct answer here. The goal isn't to force yourself to be a risk seeker if you're naturally risk-averse. The real goal is alignment. It's all about building an investment strategy that works with your fundamental nature, not against it.
So I'll leave you with this final thought to chew on. Take a look at your own portfolio, at your own financial plan. Is it a true reflection of who you are and what you can actually handle? Or is it a reflection of who you think you should be, based on some old textbook myth? Answering that question honestly, well, that's the real first step toward true financial peace of mind.